Welcome, everyone. Welcome to today's KPMG LinkedIn Live event. We've got a great discussion planned for today around the economic forces impacting the banking industry. I'm Peter Torrente, the U.S. sector leader for KPMG's Banking and Capital Markets practice, and I'm joined today by Ken Kim, Senior Economist in KPMG's Chief Economist's Office. Really look forward to an engaging discussion around what we're seeing on the economic landscape as we look forward. Some recent economic data points have come out, and really look forward to digging into those with Ken today. Ken, maybe we just get started. Maybe we talk macro to start. I think interest rates, unemployment on everyone's mind, and would love to maybe hear your initial thoughts on where things stand today and how we see them over the coming months.
Sure. Great to be back here again with you, Peter. And yes, let's talk about the economy. So in terms of the labor market, employment remains strong in the U.S. economy. The unemployment rate for March, which is the most recent month we have available. For April, it came in at 3.9%, and we've been under a 4% unemployment rate for 27 months. So we still have a very full employment picture in the United States. In terms of job growth, in April, the U.S. economy created 175,000 new jobs for that month alone. So that's a very respectable rate of job creation. In terms of interest rates, we do know that the federal funds rate is currently at a 5.25% to 5.5% range. And what's going on there is that market yields have backed up recently. For example, the Treasury 10-year yield is currently about 4.5%. At the start of the year, we were at 3.8%. So we've backed up about 70 basis points over the last 5 months. And the reason for that is that inflation has been coming in hot. In January of this year, the Consumer Price Index on an annual basis came in at 3.1%. So there was some hope that we could see a 2% handle on inflation on an annual basis. When we got the February number, inflation actually ticked up to 3.2%. And then in March, we got 3.5% for consumer prices. So we kind of went in the wrong direction with inflation higher instead of lower. And that's why market yields backed up. And market expectations for the Fed is you've probably heard the refrain higher for longer. So that's where we're currently at in terms of the economy and rates in a nutshell.
And I guess when we look forward, we came into the year, maybe some calling for 6 rate cuts, some 7. As you say, we got into March, that probably tempered a bit. Maybe you just talk about outlook for rate cuts for the rest of 24 and into 25 and how you see that playing out.
Sure. Yes, we've also rolled back our rate cut expectations, particularly for 2024. From the perspective of KPMG Economics, we're looking for only 1 rate reduction, and we think that's going to happen in December. So it's going to be occurring at the very late part of this year. Currently, market expectations are probably between 1 to 2 rate cuts, 1 happening in September, and possibly a second one happening at the December Federal Open Market Committee meeting. There is a meeting between September and November, but markets don't expect a rate cut then. So right now it's somewhere between 1 to 2 cuts in terms of market expectations. For 2025, we do expect multiple cuts in interest rates because we do expect inflation to continue to move lower as we move into the second half of 24 and then into 2025. We're probably looking at somewhere about 5 rate reductions in 2025. So we do expect the Fed to cut rates, but it's going to happen later.
Yeah. And when you look out into 25, end of 25, where do we ultimately see inflation at that point?
We are hoping that inflation will make progress to that 2% target that the Fed and as well as other central banks are targeting. So we do hope to see that on an annual basis, inflation will fall, somewhere fall into the 2 to 2.5% range, and then continue to that 2% target when we enter 2025.
When we think about unemployment, a lot of the bank's models keep unemployment data as well. How do you see the unemployment rate, over the next 18 months as you think about that and how that interplays with the two factors we've been talking about around rates and inflation?
Yeah, so the Fed actually does make public their projections of where different committee members think the unemployment rate will be. And right now, full employment is considered to be 4.1% for the U.S. economy. As indicated earlier, the most recent reading for the unemployment rate is 3.9%. We do expect the economy to slow in the back half of 2024, which does suggest the unemployment rate could move higher. So we're probably looking in the same territory, 4.1%. But, again, that's not a terrible unemployment rate for the U.S. economy. So, we would expect something in a similar ballpark going forward.
Maybe sticking with the consumer, we know the consumer has been particularly resilient and continuing to drive economic growth and spending. And I know you just worked on a consumer credit report, but maybe just some comments of highlights coming out of that report, the strength of the consumer, what we're seeing banks doing from sort of an underwriting standpoint.
Sure. Well, the consumer is still engaged in terms of borrowing. With the March consumer credit report, which was released last week, there was a slowdown in credit growth for the month of March. So in terms of total consumer credit outstanding, it grew by $6.3 billion. And the recent run rate, let's say over the past 3 months, was about $13.5 billion. So there was a little bit of a step down in consumer credit. And that's because of the higher rate environment that consumers are currently enduring. So going forward, consumers still want to maintain their lifestyle. So they will have to be responsible in terms of their consumer borrowing going forward. But another thing is, with the strong labor market that we're currently experiencing, that means consumers or employees are having wage growth, and that continues to provide them with the wherewithal to continue their spending, whether it's on goods or services. And some of them may have to supplement that with consumer credit borrowing going forward.
Maybe sticking with kind of the lending theme, we recently had published the senior loan officer opinion survey, and I know that has a lot of information coming directly from the banks. But maybe spend just a couple of seconds for those that may not be familiar with the survey on kind of what it is, who's surveyed, and then we can maybe get into a little bit of the highlights coming out of that.
Sure, Peter. Yeah, the Senior Loan Officer Opinion Survey, it's also known as SLOOS, SLOOS. I know that's a mouthful. It is a very comprehensive survey. It surveys both from the perspective of lending conditions from the supply standpoint, as well as demand. And in terms of the economy, the survey encompasses both businesses and households. So you get a very full picture of lending activity from the perspective of bank lending officers for the U.S. economy. So the most recent survey that we received was for the first quarter from the Federal Reserve. And what they found was just sticking from the standpoint of businesses, lending standards in terms of business loans, C&I loans, commercial and industrial loans, they have been progressively been getting less tighter over the past year. So in the first half of 2023, let's say that was peak tightening when conditions were the tightest. And over the course of the last several quarters, conditions have been getting progressively less tight from the perspective of banks. So in the most recent survey, 16% of banks tightened standards for C&I loans to businesses in the middle and large market. And these are companies with annual revenues of $50 million or more. So 15% or 16% tightening in the first quarter is a much better reflection than when, let's say, in the first half of 2023, 50% of banks had tightened standards. So there has been less tightening over the course of the year. And then in terms of loan demand, about 0.25% of banks surveyed said they are seeing weak loan demand in the first quarter. But again, this is a better or lower figure than what we saw last year. There was also a special question on commercial real estate, and 1/3 of banks said they continue to tighten lending standards for commercial real estate properties, and that includes multi-family properties and non-residential sectors. So there is still some aspect of tightening by banks, but it is less than it was 12 months ago.
Yeah, that resonates, I think, from what we're hearing from our clients. And maybe just you touched on commercial real estate, Ken, maybe just your views on commercial real estate, given the higher for longer comment you made earlier, and some of the other aspects that we've seen talking to clients and from some of the CEO survey outlook results that we recently had.
Yeah, so certainly that does play a part. So, in addition to the higher interest rate environment, some of the reasons for the tightening in the CRE market, according to the survey responses, was that there's continued uncertainty about market rents. along with high vacancy rates and falling property prices, those were the primary reasons why commercial real estate might still have, still adjustment, kind of adjustment period to that might last for, another few quarters or so.
Thanks for those comments. And maybe turning to the financial stability report, another data point that came out recently. There's a lot in there, but maybe just some highlights from your standpoint. I think it's a pretty good list of potential issues to keep on the forefront, whether it's interest rates, inflation, geopolitical concerns, level of debt, commercial real estate you touched on, but anything else in there from sort of a highlight standpoint you think the audience would be interested in?
Yeah, the financial stability report for the first quarter was just released a few weeks ago. And what was interesting is that concerns about commercial real estate, it actually lost a place from the last report in the fall. So the current report for the spring had commercial real estate, at a certain level, but when you compare it to the previous report that was released last October, it actually fell in terms of, market participants being worried about it. The top response that garnered the most concern was the higher interest rate environment, monetary policy tightening, and high inflation. 75% of those surveyed indicated that was the most concern to financial stability risk going forward over the coming 12 months. What was very interesting was, the policy uncertainty and the geopolitical backdrop that you mentioned, Peter. That garnered the second highest response at 60% of those surveyed as posing a financial stability risk. And, of course, we do have the November U.S. presidential elections coming up. Compared to the fall report, policy uncertainty garnered only 20% of the responses. So policy uncertainty was the biggest mover in the most recent financial stability report, jumping from 20% in the fall to 60% as a concern in the spring release.
Yeah, that's interesting data points, particularly to compare year over year. How do you think about the level of debt and when you think about the longer term outlook for growth and kind of the rate environment? I know that was on there last on the list, but still made the top risks. Yeah.
Yeah, no, there is a lot of concern about our debt trajectory as well as our budget deficit. The CBO estimates that the level of our public debt will be as much as the level of our GDP. So by this year, we're expected to be basically a 1-to-1 ratio. So essentially, the size of our GDP, we have a $27 trillion economy, and we're essentially borrowing $27 trillion. That's from the perspective of the federal government. Now, late last year, we did have the U.S. 10-year yield briefly touch 5%, and there was concern about our debt situation and how pretty much, it's an unsustainable situation when you look at it in a longer term basis, going out, decades from where we are now. Well, this year, that's that situation concern has been kind of put on the back burner because global market participants are, looking forward to when the Fed will cut rates. So right now, the possibility of rates coming down later this year and next year is kind of superseding those debt concerns for the time being.
I think something definitely to continue to track. Maybe time for one more question, Ken, and kind of make it forward looking. We're sitting here, I guess, middle of May, but as you look out, say, between now and 4th of July, what are some of the key data points that you're watching to see how the economy is going to develop through the summer?
So yeah, thanks, Peter. More immediately, we do have key economic releases coming out this week, and we do get the latest number for the consumer price index on Wednesday for the month of April. And right now, market expectations is that annual reading on inflation will come in at 3.4% versus that 3.5% that we saw in March. So that would be good news if we do have inflation, coming down from that 3.5% last month. But so far this year, inflation has been surprising to the upside. So, we'll just kind of have to wait and see what that Wednesday consumer price index shows. The other key economic release I'm talking about is April retail sales. And so far, the consumer has been holding up very well in this higher interest rate environment. So the retail sales report will reflect how the consumer is faring as we move into the summer of this year. So those two economic releases will be key this week, and we could, as a result, see some market volatility if they are, either stronger or weaker than expected.
Great. Ken, thanks for sharing your views on some of these recent data points that have come out and reports and sort of forward-looking view over the next several weeks and into next year. A lot to follow. Look forward to doing this again. Thank you to everyone for participating today on our LinkedIn Live event. Please let us know if there are other topics you'd like to cover on future updates from our economics group. Please join in the chat our KPMG Financial Services LinkedIn page, and please sign up for insights from our KPMG economics team. Thank you again for joining, and have a great week.